YouTubers, and welcome back to the Independent Investor. Today I'm going to talk about B&G Foods. I opened a long position in it yesterday. The symbol is BGS, trades on the New York. It's been a fairly well-performing company over the last decade. Has moved from $5 right up to $52. It's in a low margin business, and it's mainly grown by acquisitions and increasing debt. That was one thing that I was a little bit unsure about buying at this point, because we're starting to see interest rates, especially on the 5-year Treasury, increase fairly strongly. But that was offset by the management of the company, and the main thing was the dividend. Of the dividend over 5%, though the payout ratio is fairly high, going by their history, it looks like they won't be able to continue to pay the dividend out. So trying to find a dividend paying company that has a yield over 5% right now is like a bit like finding a needle in the haystack with the markets being so expensive. Also, their tax rate was 38% last year, and with the Trump tax going through and reducing corporate tax to 21%, I think that will offset some of the risk associated with the interest on their debt. They also just did a public offering on their debt, consolidating some of it for $400 million and at 5.25%, and that's out to 2024. So that takes care of a big chunk of their debt right out to 2024. So that gave me a little bit more peace of mind. The company, again, it says has grown by acquisitions, and that's really what's being reflected in the share price. Technically, there was a bit of a head and shoulders pattern kind of forming here, so I was a little bit leery about buying right now. So if it does drop below 30, I might sell my position, but I have a hard time believing that the true head and shoulders correction would take it down to the $15, $16 range, and I don't think it's grossly overvalued at where it is right now. The PD ratio is a little bit high, but there's all kinds of pension funds, mutual funds looking for yields just above 3%, and this is well over 5%, and it looks like it's sustainable. Also, I have seen in the past head and shoulders patterns that actually sometimes do appear, though rarely, as kind of a base and a support, and then a reversal, and the share price can rise, and that might be the case here. Time will tell on that. So this is a very low profit margin business, of course, or packaged foods, but they do have quite a few brand names that we see in the grocery stores, and they've been quite active in building that portfolio of different brands, and they seem to have so far managed it quite well. And getting back to the technicals, the daily charts, we came all the way down to 40, from 48 down into the 30s here, and it looks like some of the technicals are starting to turn around. We're seeing a lot of high buying days, and then a kind of a sell-off. So it might be settling out here, and I'll be quite content if it did sell out about here, and I could just pick up that 5% plus dividend. And so they have the book value, even though with the dividend, it has increased quite steadily from year to year. Just going back to 2008, dividend was 68 cents. This year is forecast to be $1.94, and as I say, the payout ratio is quite high. But even with that, they've been able to maintain their book value and actually they've doubled the book value over the last 8 years or so. It stands at about $12 right now. Half of that book value or more is in intangible assets, which is a little bit, those intangibles could be written down if the purchase they made don't really generate the free cash flow that was expected from the acquisitions when they were done. But still, it's a pretty solid, I think, the fundamentals for where the market is right now. The revenues have grown about 300% since 2009, or 500 million, and this year is going to be about 1.6 billion. And the return on equity for a very low margin company has been very well. They seem to maintain it in the high teens to the low 20s. So they did have some troubles last year. That explains some of this. They missed the quarter, but it looks like they're getting back on track now. So with a yield around 5.3, 5.4%, I thought it was an excellent opportunity to open up a position, and I'll have to monitor it going forward on the technical side, and have to see the next quarter's earnings if their earnings are back on track. But going by the history of the company, it looks to be quite well managed, and I thought it was a good opportunity to open up a position in it, a long position. Their dividends are covered from cash flow from operations, and so that also was fairly positive. And so for a very competitive industry, selling shelf-stable food, household products, that type of thing. I thought, very well managed, and so there's a good chance here of a nice steady dividend, and also a fairly good possibility of a capital gain, especially if it gets back up into the the $40–50 range. It did hit a high of around $55 back in 2016. So there's a good total return potential on this one of maybe high single digits, low double digits, depending on what the market does overall. Again, I'm a little bit concerned about the overall market valuations, but even if we did have a correction, a high dividend paying stock is going to have a lower beta and fall less than the market. So it does to me, it makes more sense to be in more conservative, lower beta stocks, which I have mentioned in previous videos. Anyways, that's just a quick video, and I'll have to see how this one goes, and thank you for watching. Bye.